Moving your pension fund, provident fund, or retirement annuity to a post-retirement fund is a massive step. Some decisions are permanent. In this video, I'll show you how to decide how much to take as a lump sum and how do you approach the decision for the balance. I'm Henri, I'm a certified financial planner and I help people who have built up assets align their money with the life that they want. Okay, so here's what you'll get from this video. You'll see how the retirement lump sum tax table works. You'll get a framework to approach the decision on how much cash to take for your needs and an emergency fund. And then I'll show you how to compare life annuities, living annuities, and the possibility to blend those two to find the best solution for your goals. Just a quick disclaimer, this video is educational. Please speak to your financial planner before you make any decisions. Okay, so step 1, align with your partner. Sit together and write your goals. List essential costs like housing, food, transport, medical aid and gap cover, and your insurances. Then list your wants, travel, hobbies, family support. Decide what you'll cut first if needed, and agree who has what responsibilities in your budget. Step 2, decide your lump sum and understand the taxes. So list what you need cash for, like a big lump sum. For example, to clear your debts, fund essential repairs, replace your car if needed, and to build an emergency fund if you don't have one. But keep it tight. Remember, every rand you take reduces the capital that must fund your income later. Okay, so make sure you understand the taxes. Retirement lump sums use a special table. From 0 to 550 is taxed at 0%, 550 to 717 at 18% of the amount above 550, and then from 770 to 1.155 million is taxed at 39,600 plus 27% of the amount above 770. And then if you go over 1.155 million, it's 143,550 plus 36% of the amount above 1.155 million. Just remember that SARS adds up all prior lump sums and withdrawals when calculating the tax. You can and must ask your fund or your advisor to request a tax directive before this payment is made so you can make sure that you are paying the expected amount of tax, and if there's a discrepancy, find out what's going on. Okay, on a side note, if you've made contributions in excess of your allowed deduction, you'll have disallowed contributions, which will allow you to either reduce the tax that you pay on your lump sum, or you can use it to offset annuity income later under Section 10C of the Income Tax Act. But that will be on SARS records. And just remember, there is a de minimis value. If your fund value is under 247,500, you are allowed to take the full amount in cash. Okay, so just 2 important dates. The first is for Provident Fund members, 1 March 2021. Here, Provident Fund reform starts, and contributions from this date follow the 1/3 cash, 2/3 annuitization rule, like with pension funds or retirement annuities. Amounts before this date are vested, so many members can still take that full vested portion in cash as a lump sum at retirement. So make sure you confirm your fund rules. The second important date is 1 September 2024. Here the two-pot system starts. That simply means new contributions are split into a savings component and a retirement component. Amounts before the change sit in a vested component. At retirement, you can still take the savings component in cash, and then the retirement component must be used to get a post-retirement income. So check your statement for the split. Provident Fund members who were 55 or older on 1 March 2021 are exempt from the two-pot retirement system and the annuitization rules. So what makes up your lump sum at retirement? It's the accessible savings component plus any vested portion of your fund that you are allowed to commute. In most cases, this will be 1/3. That cash is taxed by the retirement lump sum table, and that's the one we just discussed. Okay, so what to use the lump sum for? Cover your needs first, keep a proper emergency fund, clear all your debts, avoid draining capital that must fund your income later. Most people face liquidity pressure long before they physically run out of money. Plan cash reserves very deliberately. Okay, so the second example is you've used the lump sum in the past, and then SARS aggregates your prior lump sums and withdrawals and your remaining tax-free amount is either very small or zero. Here we would sometimes still recommend taking some cash that you can keep an emergency fund and cover your basic needs, because you need liquidity, and then keep the rest to fund your income. So the third step would be to compare your tax on your income versus the tax on your withdrawal. The goal is to get the cash into your bank at the lowest tax cost, even if you reinvest or use it later. Okay, so here's a short example. You need 400,000 for your needs and your emergency fund, but we would still recommend taking that extra 150,000 if you can get it out on the 0% tier, because you get it out at 0% tax. Because if you take it out later as an income and your income is paying tax, then it would be cheaper to take it as a lump sum. Compare what it would cost to draw income versus what it would cost to take it as a lump sum. Okay, just the obvious caution, taking more cash reduces your annuity capital and you'll have less money to take as an income. So test this in the context of a holistic financial plan. Okay, step 4, see what is left for your income and choose your income structure. After tax and setting aside cash, the balance is your income engine. This is the amount you'll use to buy an annuity or annuities. You broadly speaking have two options, a life annuity and a living annuity. Let's start with a life annuity. This is an insurance contract that pays an income for life. You trade access to your capital for a guarantee of income. In a life annuity, you have growth options. So the first is a level annuity. This is the highest initial income, but you'll get the same amount in rand for the rest of your life. So it loses buying power over time due to inflation. Then you have a growing annuity that can either increase with inflation or at a fixed rate. And that starts lower, but it has better protection of your buying power in the future. Usually the lower it starts, the higher your increases would be over time. Then you have a with profit annuity. Your income can be in this annuity grow based on the investment growth from the insurer's with profit fund. The starting income usually sits between a level and inflation-linked annuity, and your future increases depends on the investment performance of the underlying fund. So the increases aren't guaranteed to match inflation every year, but your income can, however, not go down. Then there are some add-on options. You can add your spouse or a joint life option. Then this simply means your income continues after the primary contract holder passes on, often at a range between 50 and 100% of the original annuity. Choosing this will usually lower your value slightly. Okay, then you have a guaranteed period. Here the insurer pays for a minimum term, usually up to 25 years. If you or you and your partner, in the case of a joint annuity, pass away before the end of the period, the payment have to continue to your beneficiaries for the balance of the term. The longer the guarantee, the lower the starting income will be. We find this a very useful option to make sure you are covered in the event of early death, that your income will go to someone for a period. If you, however, pass away after the guarantee period, no income is payable. So just an example, let's say you have a 20-year guarantee with a joint life annuity and you and your partner pass away after 7 years. Your income will still be paid to the beneficiaries, say for example your children, for another 13 years at the end of that 20-year guarantee period. The access to capital, you generally cannot access your capital once the contract starts. Your choice of spouse and guarantee features defines what, if anything, is paid after death. And just a very important note, you cannot move out of a life annuity later. That decision is fairly permanent. Okay, and then moving on to a living annuity. A living annuity is simply an investment account where your capital stays invested. You choose a yearly drawdown between 2.5% and 17.5%. You can change it once per year on your policy anniversary. But remember, you cannot make ad hoc withdrawals out of the fund. The remaining capital will go to beneficiaries on your passing. So the key risks to managing a living annuity is firstly sequence risks. This means you have poor market performance early on, and especially combined with high drawdowns. This can shorten how long your money lasts. So longevity risk is simply you living too long for a higher drawdown or a low return path. That's basically you outliving your money. Then there's inflation risk. That means your income doesn't keep up with rising costs of everything around you. And then investment risk is just being in the wrong asset mix, or if you're too highly concentrated, or if there's some type of investment mistake or too high fees in the investment that causes it to have a non-ideal outcome. So, and then the last one is very important, and the one that that you have the most control over is behavior risk. So this is making emotional decisions in markets that damages your future prospects. A good example here is in COVID, there was a 20-30% drop in the market, and then it recovered fairly quickly. But if you panicked at the bottom of that and switched to, say, a money market fund, you would have never caught up to the people that just stayed invested. So managing your own behavior in investments is very important, especially when it gets difficult. Okay, some controls you can set in place is set an evidence-based drawdown. We usually recommend around 4 to 5%, and then to match that your asset mix with that drawdown. So that just simply means if you are taking, say, 4% or 5%, let's say 5%, and you want to keep pace with inflation, which is, let's say, in the example, also 5%, then you have to get a growth on your investment of at least 10% to do that, because you need a 5% inflationary increase and you are taking 5% as an income. So you need 10% at least, so you should get assets that can produce that. And then it's very important to keep your fees in check. Any fees that you pay should get you value for what you are paying for. And then it's very important to review your plan annually. It's not a set and forget thing. You have to stay on top of it and see that there's alignment between your money and your goals throughout, because your goals will also change as time progresses. Okay, and so you can move from a living annuity to another living annuity, or to a life annuity with what's called a Section 50 transfer, and that carries no cost. And a common question is, can you blend it? Yes, you can split it. Some people prefer to lock in their essentials, for example, with a life annuity to cover their basic needs, and then they use a living annuity for flexibility, for growth, and for their legacy. Ask your financial planner to request and compare proposals, and then select a combination that best aligns with your goals, tax, and estate outcomes. Okay, so what should you know about death and beneficiaries? Before retirement, Section 37C applies to death benefits from approved retirement funds. Trustees allocate fairly among dependents and nominees, so your will does not control that money. After retirement, your will still doesn't control the money, but your beneficiary nominations are directly carried out, and they are critical. So living annuities pay according to your beneficiary nominations. Life annuities usually stop at death unless you added spouse or guaranteed features on it. So it's very, very important to keep your nomination up to date. This money does not form part of your estate, but it will be taxed according to the retirement tax table if cash is taken in the hands of the person that passed on. If your family or spouse transfers the money to their own living annuity, there's no taxes on that transfer, but they do pay tax like you did on the income that they take. Common mistakes to avoid is assuming the right lump sum before running the numbers. There's no one right number that's right for everyone. So it's very important to do the calculations and see what's the right thing for you to do. The second mistake we see is ignoring liquidity. That just means you don't have money when you need it. Even if you have, for example, money in a living annuity, but you cannot make a withdrawal from it if you need a big lump sum. So make sure you have an adequate emergency fund. Holding an amount in cash gives you a massive amount of financial resilience not to make bad decisions or decisions under pressure or forced selling of any assets. So the third mistake is setting a limiting annuity drawdown too high for your portfolio and the market you're in. And when you do that, the sustainability of your investments falls very quickly. So let's say you are in a money market that gives you 6%. You feel great because the money's going up, but you are taking 5% of that 6% per year. Remember, then your money is only increasing with 1% a year. And then if you account for inflation, let's say it's 5%, then you're effectively becoming 4% poorer every year. So you have to plan and make sure that your income can sustain your lifestyle over time. The last mistake we see is assuming beneficiary nominations are not important. They decide who gets benefits on policies after retirement, and not having them can have real consequences in terms of taxes. Make sure your investments, insurance, and your will are working in the same direction. So, if you need a list on what to do next, write down your cash need and your income need. Ask your financial planner to request and compare life and living annuity proposals, and then compare guarantees, features, costs, and choose the one that best aligns with your goals. Update all your beneficiary nominations and keep an estate file. It can even be one page with contacts and instructions. This will make it a lot easier for your family. And then review your plan at least once a year to ensure continued alignment. And yes, in our practice, we always say align your goals, align your money, and live fully.